Geely Automobile's third quarter of 2025 really was a pivotal moment for the company, and it marks what appears to be a significant inflection point. In this analysis, we're going to deconstruct the financial, strategic, and operational shifts that are shaping the company's path forward, all based on the very latest data. So what's the big picture for Geely's third quarter? Well, it was really defined by a fundamental shift in the quality of its growth. We saw record highs across key financial metrics, which signals a structural improvement in profitability. And this performance, it's underpinned by a deeper strategic integration and, of course, the strong output from its core growth engines, its new energy vehicles, and a newly restructured export business. To really understand this shift towards what we're calling profitable growth, we have to start by examining the hard data. So that brings us to the financial performance in detail. The headline figure that really jumps out is this: a 59% year-over-year increase in net profit attributable to shareholders. This is a substantial number, and it's the primary indicator of a landmark quarter. It's really the right starting point for our deeper financial review. Now, looking at the comprehensive performance, you can see total sales volume saw a really robust 43% increase. That translated into a 27% rise in revenue, but critically, core net profit, which strips out any non-recurring items, was up 19%. That confirms the strength of the underlying business operations. And this is where the story gets really interesting. This data reveals a critical shift. Geely isn't just selling more cars, it's selling them more profitably. In the third quarter, the average net profit per vehicle increased to about 5,200 RMB. That's a 16% sequential increase from just the first half of the year. This gives us clear evidence of successful margin-accretive scaling in its new energy vehicle business. A DuPont analysis helps us understand what's driving this shareholder return, and it reveals three key trends. First, the net profit margin is solidifying, and it's being supported by a better product mix. Second, asset turnover has improved, which tells us that prior capital expenditures on new platforms are now generating revenue more efficiently. And finally, a strategic increase in the equity multiplier reflects the financing of its NEV expansion. It's the combination of all these factors that's driving those strong returns on equity. Now, these strong financial results, they didn't just occur in a vacuum. They're actually the outcome of some very significant strategic and accounting changes, which we're going to examine now to provide some essential context. The company's recent actions are framed by what it calls the Taizhou Declaration. This quote signals a deliberate, focused strategy of internal reorganization. It's all designed to sharpen the company's focus on the smart electric vehicle sector and to drive a comprehensive transformation. Now, a key part of this restructuring involves a shift in accounting methodology to something called common control merger accounting. In simple terms, this just means that for internal mergers, assets are combined at their existing book values. The primary implication here is that this method avoids creating artificial gains or goodwill, and that provides a much clearer, more transparent view of the performance of the newly integrated entity. And this accounting change is best understood by looking at how it was applied in the consolidation of Lynk & Co. So Geely's subsidiary Zeekr acquired a controlling stake. This led to Lynk & Co. being reclassified from a joint venture to a subsidiary. Financials were then restated under this new policy. The strategic thinking behind this is to streamline the brand portfolio, reduce internal competition, and unlock deeper synergies in R&D and supply chain management. Okay, so having established the financial performance and the strategic context, we can now dissect the two primary engines that really powered this quarter's growth: new energy vehicles and exports. The most significant operational shift is right here, in the sales mix. In the third quarter, new energy vehicles accounted for 58% of total sales. Now, crossing this 50% threshold is a major milestone. It signifies that Geely has effectively transitioned into an automaker where NEVs are the majority of its business. And the main driver behind this entire transition is the absolutely explosive growth of the Galaxy brand. In the third quarter, Galaxy sales hit 327,000 units. That's a year-over-year increase of 170%. This brand has very rapidly become Geely's primary engine for capturing market share in that mainstream NEV segment. But if we look at the broader portfolio, we can see a very complementary strategy at play. While Galaxy is driving the volume, the premium Zeekr brand is establishing a strong foothold in the high-end market. At the same time, Lynk & Co. is successfully pivoting to a majority NEV portfolio, and let's not forget, the China Star Series continues to provide a stable base of cash flow from its fuel vehicle sales, which is crucial for funding the overall transition. Now, the export data tells a nuanced but very important story. While the total export volume for the first 9 months shows a slight decline of 7% year-over-year, this actually masks a significant underlying improvement. You see, the decline was driven by a strategic reduction of exposure to higher-risk markets. But in contrast, NEV exports surged by 214% over the same period. That indicates a decisive pivot toward higher-value, higher-margin products in new global markets. So, with this strong Q3 performance as a foundation, let's now turn to the future and examine the company's product pipeline and management's own assessment of the competitive landscape. And it looks like the product offensive is set to continue right through the fourth quarter. The pipeline includes key launches for the Galaxy brand, a significant technology upgrade for Zeekr with its 900-volt architecture, which enables much faster charging speeds, plus updates to core Lynk & Co. models, and even a refresh for a key fuel model. This dense launch schedule really demonstrates a commitment to maintaining momentum across all segments. So, how does management see the road ahead? Well, their strategic assessment is that the industry is entering its endgame. Market share is concentrating among the top players. The top 5 now control nearly half the market. They anticipate that policy changes, like the removal of subsidies, will only accelerate the exit of weaker competitors. And within this context, Geely positions its dual-track strategy, maintaining both EV and conventional vehicle lines as a source of resilience, while leveraging its traditional strengths in supply chain and cost control to build a competitive advantage in the NEV era. And this all brings us to the central question that arises from this quarter's performance. The industry is consolidating, and we know competition is only intensifying. The data from the third quarter indicates that Geely has developed a successful model for profitable growth. So the key question for the future is whether this model of strategic integration can sustain its momentum and continue to capture market share in this rapidly evolving landscape.